Hey guys, coming at you live from my house this morning. Today we're going to start talking about the stock market. And we're going to look at one of our I can statements of I can explain how investing may build wealth and help meet financial goals. But before we get into that, we have to talk about what stocks are and how you invest your money in companies. What does it mean to invest? And so in the next few minutes here, I'm just going to go through a presentation on stocks and give you some ideas of how people invest their money in companies, and those companies then make money for the people. All right, first thing, what is a stock? Well, companies have stocks. So companies like Apple, like Pepsi, like Hershey's, those would be some companies that have stock. We will look into more companies that offer stocks later. A stock is a share of partial ownership in the company or a little bit of the company. Okay, so if you own stock, you own just a tiny small part of that company. If the more stock you buy in the company, the more you own of them. A share of a corporation can be held by you, one person, individual, a group, or another company. So if Pepsi wanted to buy into Apple, they could. Okay, they could do that, or it could be a group of people, and that's what we're going to work with is a group of people here in this class. Why would a company sell stock? Well, they sell stock when they need to raise money. They've decided, okay, our owner has put in enough money, and we need to get more and more and more. So we'll offer some people to buy into the company, and they can make choices. But then that way we'll get their money to spend. Um, in exchange for that money, the company gives partial ownership. When a company does this for the first time, it's called an IPO or an initial public offering. I remember probably about 3 or 4 years ago, Facebook did what's called going public, and they had their IPO, and people were so excited to buy into Facebook. Then in our country, Facebook started not looking so great, and so people stopped investing in it, and the stock price or the stock value went down. A stockholder. Stockholder is somebody who owns stock in a company, who is a partial owner. And like I said earlier, that can be one person, that can be a group, or that can be another company. So when you buy, you immediately own whatever the company owns. So say you've got a company like Pepsi. Pepsi also owns Mountain Dew and Gatorade. If you buy stock in Pepsi, you also partially own Mountain Dew and Gatorade. Now that does not mean you can go to Casey's and be like, well, I own part of Pepsi, so I can have a free Mountain Dew. It doesn't work like that. You still have to pay for it, but you may see some of that money come back to you. Investors try and oftentimes what's called diversify portfolios. This just means that they have a stock in a wide variety of companies. I may own stock in Nike and in Netflix and in Amazon if I can afford it. And I try and have different types of things. That way, if something bad happens to one, I can be safer in my investments. Having a wide variety limits the risk. So yeah, if a company starts to lose money, like say Netflix starts to lose money, I'm still okay because in my previous example, Nike is still making money, and so is Amazon. So one way you make money in owning a stock is called the dividend. So every year, or maybe even every quarter of a year, a company will pay their stockholders dividends. So they'll take all the money that they made during that time of year, after they've paid all their employees, after they've paid to keep the lights on, keep their bills, after they've paid for all the materials they need to make their products. They'll take all the money that's left and then they'll just divide it up over their stockholders. So, say I own 1 share of stock and you own 7 shares of stock in the same company. You're going to get 7 parts of that pie, 7 pieces of that pie. I'm going to get 1 piece. So you'll get more money because you own more stock. How is stock bought and sold? Stock is usually purchased through a person called a stockbroker. Okay, a stockbroker is a person who knows about the stock market and what companies are good to invest in, what companies you probably shouldn't invest in, and they will advise individuals about when to invest. He or she advises people on what stocks may be good, and then they're like your legal representation in the buying process. They make sure that the company isn't going to like screw you over in the long run. They're going to make sure that you actually get what you're paying for. The broker gets paid a little bit on the percentage of their sales. So say you buy $500 worth of stock, you may actually have to pay $550 because you have to pay the broker that extra $50. How do stock prices go up? Stock prices go up because more investors want to buy the stock than sell the stock. If a large number of investors want to buy a stock, the price just shoots right up. But say the company has like something bad happen or somebody makes a better product, people won't want to invest, and so their value will go down. If stock prices are rising, we call that a bull market. If like a lot of stocks are rising, we call that a bull market. If stock prices go down, like I just said, more investors want to sell. Stakeholders may be willing to sell, offer, if you own a stock that you think is worth $50, but it's not going well, prices are going down, I may offer you $35 and you take it. So yeah, this is called a bear market. We don't want to see that overall in the stock market. A bear market would be very bad for us. A stock exchange is a place where stocks are bought and sold. There are many of them around the country. Wall Street has a few of them. The New York Stock Exchange is the big one here in the U.S. You all may also have heard of the NASDAQ. We'll talk about the NASDAQ a little bit more here. That's another huge one here in the U.S. New York Stock Exchange is the oldest and largest one in the U.S. It's on Wall Street, like I said. They're responsible for making the companies that sell there follow all their laws and all their rules. NASDAQ is an electronic exchange. All stock changes are done like on the internet. Basically, there's no physical location. There are 2 types of stocks that companies can give you. One is called a preferred stock, and the other is a common. We'll go to common first. Common is what's most frequently used. That's why it's called common. You get basic ownership, nothing special, just when, and you get partial ownership. So when all the owners meet to discuss what the company should do, you get an equal say to most people. Companies issue common stock first, and then they'll issue preferred stock later if they still need to. Common stocks usually do better. You usually get more money for a common stock than preferred stocks or preferred shares over time. But there is a risk. Common stockholders don't get paid until preferred stockholders get paid. So, like I was talking about with that pie earlier, if I'm a common stockholder and you're a preferred stockholder, you may not get quite as much of the pie, but say it's a really small pie, you'll actually get your piece, and I may be left in the dark if the company didn't make enough money this year. Preferred stock is a stock only issued after common stock is sold, like I said. preferred stockholders don't have voting rights, so they don't have any say in what the company does. They just are along for the ride. Preferred stockholders get paid their dividends first, though. So if the company only made like $1,000,000 and they have preferred stockholders that say, well, we need at least $100,000, they have to get that $100,000 first, and then the common stockholders get what's left of what's rest, or their share of what's left. The dividends are fixed, so they automatically are going to get that $100,000 no matter what. Like they'll say, okay, I'll buy your preferred stock, but every quarter I get $100,000 every quarter of the year. So through the year they get $400,000. That's pretty good. Or it might be $1,000, or it might be $100, or whatever it is. But they have to be paid first before the common stockholder gets anything. So if I'm a preferred stockholder and I say I get $100,000 and the company only made $110,000, I get my $100,000, and the rest of you common stock people have to split that $10,000 that's left. These aren't sold in public. You have to be invited to buy them. So you got to know somebody. Okay. All right. Next one. There are different levels of stock. Okay. Obviously, there are companies that everybody knows. They're all over the world. There are some companies that are super local that still may have stock. One of those, the high-end, everybody knows it company, is called a blue chip. It gets this name from poker because the blue chips have the highest value. Okay, but this is a very solid, reliable company, long history of growth. If you invest in a blue chip stock, odds are you're not going to see like huge returns. You're not going to get rich quick, but if you hold on to it for a long time, you'll see your investment grow and grow and grow and grow. There's defensive stocks, a stock that tends to remain stable no matter what. These are things that people always need, okay, like food and oil and gas for their car, utilities. Okay, so if I go back to the last one, Coca-Cola and Nestle would be very good defensive stocks. Okay, those make food. People are going to buy food. Walt Disney, maybe not, because people didn't go on vacation to Walt Disney World this summer, so they might not see as much money come in. Okay, so that would not be a very defensive stock. Penny stocks, a nickname for very low price stocks. These stocks are considered high risk, very high risk. They're priced low because the company hasn't proven themselves, and they're probably new. They don't make very much money very often. Now, last year I saw a student invest in a penny stock, and then like 2 months later, the stock price just went up. He bought it for like 5 cents a share, and it went up to $12 a share. He made $20,000, hypothetically, in our game that we play. And great for him. But that company also could have gone bankrupt because nobody was buying their product. That would have been a major issue for him. How to pick a good stock. Look for companies with strong, long-lasting earnings. That person that bought in the penny stocks didn't really do that, but he got lucky. Okay? It's good to research the company before you invest in them. Know what they make. Okay? Like I said, Pepsi, if I invest in them, they have Gatorade, they have Mountain Dew. If I look at Disney, Disney owns ABC, they own ESPN, they own different companies like that. So it's good to know what I'm actually investing in. There are many ways to do research about this on the internet, okay, but a quick Google search is probably a pretty easy way. And remember, when you buy stock, you're betting the company will do well, and more people will want to buy that stock, okay? So you're not just saying like, oh, I'm just going to pick a random one. You want to put your money into something you trust will do well. And make sure you invest that in stocks that are in high demand and offer products that are in high demand. If I invested in a company that made CDs and cassette tapes, that's really, really, really foolish because nobody buys those things anymore. They download them off Apple Music or Spotify. And you should track your stocks regularly to see how your company is doing. We're going to check them at least once a week in this class. how to make money from selling stocks. So you can profit through your dividends, which we talked about again. That's like when the company makes money throughout the year, you get some of the money that they made at the end of the year. You can also make money by selling your stocks for higher prices than you bought it. So say I bought into Pepsi and it cost me $30 a share. Well, then Pepsi, people keep buying and buying and buying Pepsi. They say that their stock value is now $57 a share. Well, I'm going to sell my shares and make $27 for every share that I bought, every part of the company that I bought. All right, that is it for investing. I know that that's a lot, and I hope that you took time to pause the video, take good notes, and do all those smart things. We're going to talk more about this in class, and then we're actually going to look into putting you into groups and buying stock as a group. We'll go over that here pretty soon. But thanks for watching, guys. You rock, and have a good day and be good people.